Chapter 9, Exam Review, Most Missed Questions. First question. ABC has cash of $32,000, accounts receivable of $42,000, inventory of $22,000, and equipment of $62,000. Assuming current liabilities are $30,000, the company's working capital is what? Okay, working capital is the money available to meet your current or short-term obligations. And working capital is figured out as taking the current assets minus current liabilities. So in this situation, our current assets are $32,000 in cash, accounts receivable of $42,000 and $22,000 in inventory. Add all that together and then subtract off the current liabilities, which are $30,000. So working capital would be $66,000. So let's see here. Second question. ABC has total current assets of $59,000, including inventory of $17,000, current liabilities of $35,000. The company's current ratio is how much? Current ratio tries to answer the question, can the company pay its bills on time? And the rule of thumb is they should have twice as many current assets as they do current liabilities, or the ratio should be 2 to 1. So current ratio is current assets divided by current liabilities. In this case, looks like we've got current assets of $59,000 and we've got current liabilities of $35,000. So we've got 1.69 to 1. That means for every $1.69 in current assets, we've got $1 in current liabilities. And according to this rule of thumb, this company is a little bit low. But to know for sure, you'd have to compare it to maybe other companies in the same industry. Here's some examples. I usually ask my class to figure out what the current ratio is for the following large companies, and since you're not in class right now, I'll just go ahead and see if you can see what these are here. I'll figure them myself here. So it looks like Walmart is 0.76, Amazon is 1.10, and these are all to 1. Kroger 0.75 to 1, and GE is 1.73 to 1. So it looks like if you would ask which one of these four companies has the best current ratio, you'd have to say GE. And that's kind of strange because these other companies are in much better overall financial shape than GE is. Next, this question wants to know what's the company's current ratio. All right, we've got all this information and we're going to figure out current ratio. Current ratio again is going to be the current assets divided by current liabilities, and it looks like our current assets are going to be $7,200 in cash. Looks like $13,350 for accounts receivable, $15,600 for inventory, and $2,400 for prepaid expenses. That's all the current assets. We didn't define current assets. We should probably do that right now. Current assets are anything that you think is an asset that's going to last no more than 1 year. And we'll divide this by current liabilities. Current liabilities in this problem would be accounts payable of $3,270 and $7,430 for salaries payable. And looks like current liabilities are going to be any kind of liability that is due and payable within 1 year or less. So when you add up the current assets and add up the current liabilities, you get $38,350 for current assets, and you get looks like $10,700 for current liabilities. So it looks like it's a 3.6 to 1 ratio. So this company looks like they can pay their bills on time, no problem. Next question. They want to know what is the working capital. Well, working capital is current assets minus current liabilities. So in this problem, we've got the following. We've got cash. These are current assets. Cash $4,600, accounts receivable $10,750, inventory is $14,300, and $1,100 worth of prepaid expenses. And we've got current liabilities of accounts payable of $2,490 and $8730 of accounts payable. And when you combine all these things together, you get current assets of $30,750, current liabilities of $11,220, and the working capital would be the difference, which is $19,530. Next question. Assuming that net credit sales for year 2 totaled $153,000, what is the company's most recent accounts receivable turnover? Accounts receivable turnover is a ratio that measures how quickly you're collecting your money in accounts receivable. So the calculation is figured out like this. You take net credit sales and you divide by the average of accounts receivable. And you get the average by taking the beginning accounts receivable for the year plus the ending accounts receivable for the year, add them together and divide by 2. And they want to know what is the most recent accounts receivable turnover. All right, so that would be the credit sales for year 2, because that's the most recent year, 153,000, divided by 5,800, which would be the accounts receivable at the end of year 1, which is the same thing as the beginning of year 2. So we're looking at this beginning year 2 plus the end of year 2, which is 7,800, add them together, divide by 2, and divide that whole thing into the credit sales. So it looks like this company is turning over their accounts receivable 22.5 times a year. So we don't know if that's good or bad. We know that we could look at past years and see if it's increasing, decreasing. We could also look at companies in this company's industry to see how the industry average should be and compare it to that. So what does that mean? It means that if we're collecting things too fast, where our credit policies are usually too tight and we're probably losing sales to somebody. If the ratio is too slow, it means that the credit department isn't operating efficiently and we've probably got quality problems, which means we're probably selling to people we shouldn't sell to. So this ratio, this number of times, should be kind of a sweet spot number. It should be somewhere between being too fast, that is where your credit policies are too tight. Like I said, you're not selling to people that you should be selling to, or it's too slow. Next question. Assuming year 2 net credit sales totaled $139,000, what is the company's average days to collect receivables? And we're going to use 365 days in this calculation. Some books use 360 days, which is a business year. But we're going to use 365 because they told us to here. So let's see what we've got. The accounts receivable turnover is the first thing we're going to do, which we did that in the last problem. And again, that was net credit sales divided by the beginning plus the ending accounts receivable balance added together, divided by 2, and then divide all that into the net credit sales. We'll figure that calculation out first, which will be the $139,000 in credit sales divided by the $22,500 worth of credit accounts receivable for year 1 at the end of the year, which is the same thing as year 2 at the beginning. Add to that the $24,500, which is the ending accounts receivable balance. Add these two together, divide by 2, and then whatever that number is, divide that into 139. We're going to get there. Just hang on, we get to this other calculation first. So we have 5.91 times is how many times we're turning over accounts receivable. That's step 1. And then to come up with the average days to collect accounts receivable, we would take 365 and we divide it by that accounts receivable turn. And that means that looks like the average amount of days to collect accounts receivable for this particular company is 61.7 days. Well, we don't know whether it's bad or good or not, but let's see if we can go a little farther and find out what kind of things to look for to see if it would be good or bad. Answers to the question, let's see how well you're managing your receivables. That's what this question tries to answer. These two registers together, really, the average days, the accounts receivable turnover, and the average days to collect receivables, both try to answer that question. How well are you managing your accounts receivable? Now, back to what is good and what is bad. At GE, we used to say that whatever your terms were, plus 15 days, that's about what your accounts receivable average days to collect should be. So, for example, if this company that we're looking at here sold things to customers and they had terms of 30 days, that is, you're supposed to pay your bill in 30 days, then we would say, okay, this company's got terms of 30 days. You add 15 to that, that's 45 days. That's about what their average days to collect receivables should be. So if we, like I said, average days to collect receivables should be 45, and if it's lower than 45, it's better to have too much. Like again, our credit policy is a little tight. If it's higher, it's a little bit worse. So they're a little slow. It looks like they're collecting their receivables a little bit slow, about 15 days slow, and we probably want to tighten up things a little bit. Next question. What is the company's debt to asset ratio? Our debt to asset ratio measures what portion of a company's assets are contributed by creditors. Bank likes to look at this. A ratio of 40% or lower is considered a good debt ratio from the bank's point of view. That is, the bank would like to have a situation where the company has more invested in it than the bank's got invested in this company. So let's see what this company's got. A ratio of 60% is generally considered to be a poor ratio, since there's a risk that the business will not generate enough cash flow to service its debt. So you can kind of see what we're looking at here. So let's see what this ratio is. So what does this mean, service its debt? It just means make the interest payment. Now, let's see. Total assets equal total liabilities and stockholders' equity. You can keep that in mind this whole class, right? That's the most important thing in the whole class, which is the asset side. It's got to always equal the liability, stockholders' equity side. Keeping that in mind, the debt to asset ratio would be the total liabilities divided by the total assets. So looks like we're going to do the following. 100, we got debt, looks like we got 14,000, 18,000 for salaries payable, and that said that was 14,000 for accounts payable, and looks like 12,000 for 12,800 for bonds payable. That's the total debt that we've got, and we want to divide that by the liability plus stockholders' equity piece, which is 149.2. And I say this because, going back to this situation, if this ratio, follow me with this now, if this ratio is total liabilities, which these are the total liabilities, to total assets, and you know that total assets have got to always equal total liabilities plus stockholders' equity, then this 149.2, which is total liabilities plus stockholders' equity, is the same thing as assets. So total liabilities divided by total assets, and that gives us 44.8, which are total liabilities, divided by total assets, which we figure, like I said, that's the same thing as saying total assets up here. That's total liabilities and the stockholders' equity. This gives us a debt ratio of 30%. And what do we say? Ratio of 40% or lower is considered good. So that means that the owners have got 70% invested in this company, while the creditors, like bankers, have got 30% invested, which is good because the more ownership that the stockholders have invested in this, or the owners have invested in this, the more likely they're willing to take, to whatever it has to do to keep the company going. Next question. What is the company's number of times interest earned ratio? All right, times interest earned ratio. That measures the company's ability to honor its debt payments. That is, how many times, this measures how many times can the company make its interest payment. Higher is better as far as the bank's concerned. The more times you can make your interest payment, that is the safer the bank feels about the loan. So let's take a look and see what the ratio is. A times interest ratio of less than 2.5 is considered a much higher risk for bankruptcy or default. So the bank would like to have this at least 2.5 times. Now, times interest ratio is, I'm going to work this two ways and show you how this is calculated. It's net income, which is this 13,440, plus taxes, which is income tax expense was $5,760, plus interest expense, which was $6,800. Add all three of those together and then divide by the interest expense, which is $5,760. Another way to say this is the times interest earned ratio is really operating income, or income before interest and taxes. It's income before interest and taxes, which in this case is $26,000, divided by the $5,760. So, oh, hold it. I said just a second ago, I said $5,760. I'm sorry. It's the $6,800, the interest expense. So let me start that again. It would be the $13,440, which is the in this case net income, plus the $5,760, which is income tax expense. We're adding that back also to the income, and we're adding back the interest expense to the income, which is is $6,800. All three of those together added up, and then we're dividing it by the interest expense, which is $6,800. And when you do that, in this case, this company has a times earned interest ratio of 26,000, which is net income, operating income right there, divided by $6,800, which is the interest expense, and that gives us a 3.8 times. And you can see that that's a ratio that the bank would like. Let's see, do we have another one here? Next one, they want to know, what is the company's plant asset to long-term liability ratio? Plant assets to long-term liabilities. The fixed asset to long-term ratio is a way to measure the solvency of a company. And banks like us to be solvent, that is, to have more assets than they do liabilities. So let's take a look at that one. Companies' long-term debts are often secured with fixed assets. They can sell these things off usually if they have a problem with the company, which is why creditors are interested in this ratio. A good ratio would be 2 to 1, because the bank figures that the worst case scenario would be they could sell these fixed assets for about half of what they're on the books for. So a ratio of 2 to 1 would be what they'd like to see. So for this company, our ratio is going to be the plant assets divided by the long-term liabilities. Looks like plant assets, in this case, are going to be $31,000. Plant and equipment net depreciation, $31,200, divided by $14,000, which is our long-term debt, which in this case is bonds payable. So it looks like that our plant to long-term liability ratio is 2.23 to 1, and looks like that meets this kind of rule of thumb here of 2 to 1. So that's good. So higher is better from the bank's point of view. Now we got another one here. They want to know, what is the company's what is the company's asset turnover ratio? Asset turnover is net sales divided by average assets. And in this case, looks like net sales will be the gross sales of $810,000 minus returns and allowances of $6,400 and sales discounts of $6,400. It just so happens that these two numbers are it's a coincidence that they're same. So just keep that in mind. It's just a strange coincidence. So when you come up with the gross sales minus returns, allowances, and discounts, you get net sales. And then you divide that by average assets. And they told you the average assets. In this case, you didn't have to completely do some kind of calculation. So the average assets are $460, and so that means that we've got net sales of $797,200 divided by $460, and our asset turnover is 1.73 times. And whether that's good or bad, it's hard to say until you look at the industry and until you look at the company, see how they were doing overall in the case of, like the last 5 years, that kind of thing. So what does the asset turnover ratio tell you? Well, again, it's let's see, we have an asset turnover ratio of 4.76, which means $1 worth of assets generated $4.76 worth of revenue. And it looks like higher is better, of course, right? The higher this is, the better it is, because you want to definitely take whatever assets you've got, and the more revenue you can generate, the better that is. And again, in general, the more turns that you have is better. But whether a particular ratio is good or bad, like I said, it depends on the industry in which your company operates. And I would ask the class at this time to get out their calculators, get out their phones, and Google asset turnover ratio of Home Depot versus Lowe's. So before you do that, which I know you're going to do that, but before you do that, which one would you think would have the better asset turnover ratio based on what you know about these two companies? So we pause for just a second, and now we'll figure this out based on what Google says. And it looks like Home Depot is 2.44. That's their asset turnover ratio, while Lowe's has an asset turnover ratio of 0.52. So who's doing better? Well, higher is better, so Home Depot is definitely doing much better.